Welcome to Talk Tickers. Today we're doing an autopsy, because what happened to Newell Brands after their Q3 earnings call was nothing short of a catastrophe. It sent massive shockwaves through the market, and we're going to break down exactly what went wrong.
Let's just start with the headline number, the only one that really mattered on October 31st, a drop of nearly 28%. The stock collapsed almost a third of its value in a single session. This wasn't just a bad reaction, folks. This was total capitulation. So the big question is, what on earth happened?
All right, so to understand that monumental drop, we've got to look at the numbers. The story really kicks off with a pretty clear miss on both the top and bottom lines. But, the miss itself, it doesn't even tell the whole story. It was the complete breakdown in confidence that really sent this thing spiraling. So here you can see it. Newell missed analyst expectations on earnings per share and, maybe even more critically, on revenue. Sales fell over 7% compared to last year. And look, that's not a small stumble. That is a significant shortfall. It just set this incredibly negative tone for the day before the opening bell even rang. Okay, so how did management explain this away? Well, on the earnings call, they didn't really point to just one thing. Instead, they basically described what they called a perfect storm. 3 big external problems that they said, and this is key, blindsided them right at the end of the quarter.
So what were they? First, retailers were aggressively cutting back their inventory, way more than expected. Second, key international markets like Brazil and Argentina just hit a wall. And third, Newell raised prices to deal with tariffs, but their competitors didn't, so they lost sales. Now, the really crucial part here is the timing. The CEO said these 3 things all hit at once, knocking 4 to 5 percentage points off of sales. And get this, almost all of that damage happened in one single month, September.
But hanging over all of this one big problem that just isn't going away. And that's tariffs, the escalating impact of trade tariffs. And this is a big one, because management flat out admitted that this headwind isn't just sticking around, it's actually getting worse.
Just look at this number, $180 million. That's what the company now expects to pay an extra cash tariff cost for the whole year. And what's wild is that this is a huge jump from what they were estimating just a couple of months ago. This is absolutely crushing their margins and making their whole pricing strategy a complete mess.
So you hear all that and you think, wow, this is a disaster. But despite these really bleak results, management didn't just surrender. No, they tried to pivot. They really tried to frame this whole counter-narrative, saying, hey, look, there's underlying progress here. Our turnaround plan is still on track. And this is really the core conflict of the whole earnings call, right? On one side, you have the grim reality. Sales are plunging, margins are getting squeezed. But on the other side, you have management pointing to what they see as progress. They're saying, look, overhead costs are down as a % of sales. We're spending more on ads than we have in a decade. We've got over 20 new innovations coming. Their argument was basically that the bones of the company, the structure, is getting better, even if the sales numbers don't show it yet. This was the big message from the CEO, Chris Peterson. It was all about resilience. He kept saying these are just short-term macroeconomic problems, not a fundamental flaw in their strategy. But the market, and maybe more importantly, the analysts on that call, they just were not buying it. Not at all. Which brings us to the Q&A, the analyst gauntlet. And oh boy, this is where that whole "these are just short-term issues" narrative completely fell apart. It exposed this really deep skepticism from Wall Street, and it all centered on one simple theme: visibility. As in, does management actually have any visibility into their own business? This question right here, from Lauren Lieberman at Barclays, it was just surgical. It cut right to the core of the credibility problem. She basically asked, the miss is huge. Given how connected you are with your retailers, how could you have possibly not seen this coming so late in the quarter? And the CEO's answer, it basically confirmed everyone's worst fears. He said, yep, it was the confluence of those 3 factors that all hit at the back end of the quarter. Think about that. The entire reason the quarter was a disaster happened in that final month. For an investor, that's a massive red flag. It doesn't just mean you had a bad September. It signals a critical lack of foresight and a huge spike in what Wall Street calls execution risk. And that's the whole point, right? This is so crucial. The stock didn't just crater because of the bad numbers. It cratered because of a perceived loss of credibility. I mean, when a management team seems genuinely surprised by their own results, the market completely loses faith in their ability to predict, well, anything going forward.
Okay, so after digging through the wreckage of that quarter, it is time for our verdict in the next call. We're going to give you our prediction for Q4 and our final rating on the stock.
So here's where we land. We're forecasting results at the absolute bottom of management's already lowered guidance. We just don't buy the short-lived argument. We think the headwinds from consumers pushing back on prices and retailers staying cautious, we think that's going to stick around right through the holiday season.
And that's why, given all this uncertainty and what we see as a major credibility gap, our rating on Newell Brands is a clear underperform. Look, here's the rationale. First, their visibility into their own business seems seriously impaired. Second, this whole turnaround story depends on getting back to growth, and that just seems to be getting pushed further and further out. Third, that $180 million tariff problem, that's a huge weight on margins and cash flow heading into next year. And finally, there's that credibility gap. It's just really hard to trust the short-lived issues story after a miss this big. So the bottom line is simple. The ball is in management's court now. We think this stock is going to lag the market until they can finally deliver a clean quarter, something stable and predictable, and prove to everyone that they actually have a handle on this business again. And as always, remember, this analysis is just for informational purposes. It is not financial advice.